Is it capital growth or rental income that will make you wealthy? Hi everybody, this is Jacques Fisher, CEO and founder of the IGrow Group of Companies, South Africa's #1 real estate investors group, where we teach and train real estate investors, business owners, entrepreneurs, how to leverage other people's money, time, effort and experience to build a multi-million rand property portfolio so they can retire financially free and leave a legacy to their loved ones one day. In this video training session, I want to share with you something that's very controversial, a very controversial topic, and also a very frequently asked question from my investors that I get regularly attending our live investment seminars. Jacques, what is more important, capital growth or rental income? Whilst I think we all know that it is possible to have both strong capital growth and high rental income generating properties, it is unusual to get both on the same property at the same rate every time. So normally you just don't get both. But rental yields on a high capital growth property are normally lower than the rental yield on a lower capital growth property. Ultimately, when you have to choose between the two, which one do you choose? Is it rental income or capital growth? Well, the first thing is number one is to assess your own cash flow, your personal investment strategy, and your unique financing situation according to your real estate investment plan, your goals. Now, these factors will determine whether it's going to be a rental income yield focused or a capital growth decision ultimately. So I've been in the very privileged position over the last couple of years to coach and train and also mentor literally tens of thousands of real estate investors over my real estate investment career. And I've never ever seen a real estate investor who focused on buying solely cash flow properties that became rich or wealthy. You know, one of the biggest reasons investors never become financially free is they invest solely for cash flow instead of capital growth. Now, the truth is, it's really hard to grow your wealth with cash flow. You cannot save yourself rich. You cannot save yourself wealthy with rental income. And rental income, the profit, is taxable. Capital growth is non-taxable, tax-free. When you are a real estate investor, you will need to save up deposit money for your next investment deal, right? So where is that money, where is that deposit going to come from? Is it going to come from your rental income that you've saved every single month? I don't think so. To save a few $100 a month from a positive cash flow property is not going to build up adequate cash flow for that next deposit. You're going to wait a very long time, so it's highly unlikely that investors can save multiple deposits over their lifetime if they only focus on high yielding and high income cash flow generating properties. But what you can do is you can use the capital appreciation or the equity within your properties for your next deposit on your next investment property. So if you'd invested in cash flow properties only, you'd have solid rent coming in, but like I said, it won't do much to help you with a deposit for your next investment property. And if I heard the following statement 10,000 times, I'm not over-exaggerating. People come to me and say, Jacques, capital growth is only a bonus. Only a bonus? Capital growth is almost everything. That's how you become wealthy. It's like saying it's a bonus if I invest in real estate and become financially free. The way that you become financially free should be a well-executed, purposeful, deliberate and strategic plan for any real estate investor. And that plan must include high capital growth properties that you specifically select in high growth nodes, high growth areas. I've seen this movie so many times. Cash flow focused investors will rather buy a 100 Rand per month positive cash flow property, pay 40 to 45% tax with no potential upside of capital growth, rather than buying a property that have a monthly shortfall of 1,000 Rand, but that has the potential of long-term sustainable capital growth. Investors feel that they're making a loss. So are you making a loss, or are you temporarily advancing a loan to your business, your property, until it reach its break-even point whilst building real equity through the sustainable capital appreciation? Or you can see the 1,000 Rand shortfall as an investment. That will be the worst it will probably ever be in year one, and will only get better moving forward because you will increase your rents annually. Investors lose sight of the bigger picture of real estate investment. There's a 5, 10, 20-year property perspective and picture that they need to take into consideration. Paying a small shortfall is an investment in the right high capital growth property. Always remember that this is a marathon and not a sprint, and always force yourself to see the bigger picture and always do your calculations. Income growth escalated per year is escalating from a very small value base. Capital growth escalates from a very big base, the value of the property. So let's say you buy a property off, let's say to the value of 1 million Rand, and let's use an assumption of 8% growth per annum on the rental income as well as 8% on the capital growth. Now, the capital growth, the appreciation of 8% is on a much larger amount, on the 1 million. The rental income growth escalation of 8% is on a much smaller value.
So let's say, for example, 8% on 7,500 Rand is 600 Rand per month times 12 months. That's 7,200 Rand for the year extra. Whereas 8% capital growth on a 1 million Rand asset is 80,000 Rand capital appreciation for that year additional.
Now, when you focus on building your asset base, you will trigger the compounded capital growth effect. And I know that's a very simplistic example, there's a lot more to it. But the compounded capital growth effect will allow you to create the equity within your property portfolio and will allow you to unlock the cash flow to create that deposit for that next investment property. And if you apply this strategically, you will be able to build your asset base tax-free until retirement, whilst getting the receiver in as your partner to help you fund and finance your residential real estate portfolio until such stage that you achieve financial freedom. Now, the asset base needs to create the equity, which is really what we are after as real estate investors. So what creates the equity? Well, you've guessed it, and you know the answer: capital appreciation. The secret is to get your first investment property, and then get your second investment property, and then the third. And one property will compound on top of another, which will create equity fast. I always say that capital growth gets you out of the rat race, but cash flow is looking after the asset. So go out there, invest strategically, invest intelligently, become financially free, and leave your legacy.